Good day, and welcome back to the Life License Qualification Program video series. Again, this is Jason Watt, and the concept we're going to be going through today is the mutual fund. Now, I'm hoping that you've gone through stocks and bonds in your textbook, and that you understand those two concepts now reasonably well. You don't have to understand them to a great extent. You won't be selling those products on an individual basis, but you do have to understand them fundamentally. So the mutual fund is not going to be sold either with a life insurance license. You would need a separate license, a securities license, or a funds license to sell this. But this is a basic part of several life insurance products. This is going to be part of universal life contracts. This is also going to form the basis for segregated funds, which we're going to look at much later on in Module 12. So where we're going to start is just with some basic concepts around the mutual fund. Now, you've looked at stocks and bonds, and you'll see, looking at stocks and bonds, that they have some upside. Stock and equity would provide growth potential, and it might provide income in the form of dividends. Both of those things are quite tax efficient. Our growth potential would bring with it capital gains, and you can wait to realize those capital gains when you sell the investment. And that income, those dividends, are taxed quite efficiently as well, taxed at about half the rate of normal income. Bonds provide stability for the investor, and they also provide some income for the investor. Both have their risks, their downsides, but they're both quite attractive, and they form essentially the basis of the investing world today. Now, there are some downsides, as I said, and some of the downsides are that a lot of investors stay away from them because they just don't understand what they're doing. In order to rectify that, though, we've had some investors who've had this idea. What they've decided to do is basically get together and form one collective entity, so that instead of being now a bunch of individuals, they're going to work together and act as one collective entity. Now, by themselves, they don't know enough to make this work, so they're going to go hire somebody to help them with this. They're going to hire a professional manager, which is the first and most important characteristic of mutual funds, this professional manager. Okay, so this professional manager is going to take care of our investors' goals. They're going to invest on those investors' behalf. The professional manager isn't necessarily one of the investors, although they often are. This person is really just going to be a person with a job. So the professional manager goes out and buys not just one investment, but rather they'll buy some stocks possibly. They might buy some bonds. They might take advantage of the money market and use some money market investments such as treasury bills. They might end up going out and getting involved in real estate a little bit, possibly through the use of mortgages, or possibly through some direct ownership in real estate. They won't necessarily stay in Canada, and if they're going to invest outside of Canada, then they're going to end up using some foreign currency. And from time to time, not so much as a direct investment, but rather as a way of reducing their risk, they might use some derivatives. Now, they're only going to invest here in accordance with the objectives of the particular investors. So if we have a bunch of investors who are looking for long-term capital appreciation, then we might end up using stocks here. So we have to consider what our investors are looking for. If we have a bunch of investors who are looking for income or stability, and our fund manager goes out and puts them into stocks, they're going to be exposed to risk beyond what they're expecting. Now, you'll see that the fund manager is not invested just in one place. Instead, they're invested in multiple places. They won't just pick one stock. In fact, they're not even allowed to. So the mutual fund benefits from the characteristic of diversification. This diversification helps our investors to manage their risk. They're not counting on one stock or one bond to do well, and if one fails or one does great, that's fine. The investors are still just going to ideally see long-term and steady growth. We're also going to see with this particular investment that it's very liquid. In fact, mutual funds are open-ended investments. These investors can come and go as they please. They can put money in and take money out as they please. Obviously, they have to put money in to take money out, but at any time, they can go to that fund manager and they can say, fund manager, we want to put some funds in, easy. We want to take some money out. Mutual funds have great liquidity for their investors. And then we have many different kinds of mutual funds available. There's substantial flexibility. There are about 7,000 different mutual funds available today in Canada, and many different sorts. If you want an idea of the different sorts of mutual funds that are available, there's a chart at the end of Module 12 on pages 1221 through 1224, and it describes the different types of funds that are available. And another great feature of mutual funds that appeals to many investors is that you can get away with investing in a mutual fund with just a little bit of money each month. Maybe you only have $100 or $200 available to invest each month. It can be difficult. There are some ways that make it possible, but it's very difficult to do to get involved in the stock market, let's say, with just $100 or $200 each month. But if you're looking to get into mutual funds, you can do so with those very small investments, and you have some flexibility around that. So you put money into the fund and need it out later on, you can get back to it later on. It's not that hard to do because of this great liquidity. So these are our 5 characteristics of mutual funds. We've got a professional manager, which, as I indicated, is the most important characteristic. So we're going to look to this guy right here, a professional manager. The other 4 characteristics we see are also important, but professional management is generally considered the key element of a mutual fund. All these other elements apply as well. Now we're going to see when we get into segregated funds in Module 12 that these characteristics all apply just as much to a segregated fund. In fact, I could have drawn a segregated fund here, or an IVIC, and said the same thing. All of these same characteristics would apply. All right, thanks very much. We're going to look at some more features of a mutual fund in a later video, and you'll see some of these concepts repeated when we get into segregated funds in Module 12. Thank you very much.